Could the rise in interest rates be the biggest challenge facing commercial real estate today? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In the Spokane market, commercial real estate is showing signs of resiliency despite a steep interest rate environment, high-priced properties, tariff concerns, and global trade tensions. According to industry observers, a lack of inventory is impacting commercial property prices, which have not decreased as much as expected in response to higher interest rates. Casey Brazil, Vice President and Chief Operating Officer at Spokane-based commercial brokerage Hamoen, notes that as interest rates went up, prices did not drop, because there is not an abundance of new products being built for purchase or occupation. The Federal Reserve has maintained interest rates in a steady range of 4.25% to 4.5% following cuts in late 2024. These federal rates influence economic activity and serve as a benchmark for other interest rates, including those for commercial loans. However, commercial property interest rates in Spokane range between 6.5% and 7%, making borrowing costly and challenging for transactions. Higher capitalization rates are needed for investors to gain positive leverage, as cap rates and property values are inversely related. Historically, Spokane's cap rates have ranged between 6% and 7%, but in 2021, lower interest rates saw cap rates between 4% and 5%, resulting in high-valued properties. James Black III, Senior Investment Advisor at NAI Black, explains that cap rates need to increase for positive returns when borrowing, yet high cap rates are difficult to find due to sellers' price expectations still being influenced by previous market conditions when money was cheaper. Brazil and Black both mention that alternative financial solutions are emerging to address higher financing costs, allowing sellers to meet their asking prices while buyers purchase at lower interest rates than traditional banks offer. Brazil observes a shift towards more owner contracts and cash deals in investment transactions. Investors are seeking good deals or distressed properties that provide more value. Despite these challenges, the commercial real estate market in Spokane is showing signs of activity. Sales at Hamoen have increased after a 50% reduction in 2024, with more sales occurring compared to leasing. In January, they handled the $12 million sale of the River Point 1 building to Spokane Public Schools. Nationally, new inventory is outpacing absorption for multifamily, retail, and industrial properties, leading to higher vacancies. Office demand is lagging, contributing to a record-high vacancy rate of 14% with minimal rent growth. However, in the Spokane market, office properties on the periphery are performing better than those downtown, where high vacancy rates and other challenges persist. The retail sector in Spokane Valley has seen significant improvements over the last decade, with vacancies dropping from 12 to 15% to around 4 to 5%, considered a healthy market. However, downtown retail struggles due to its reliance on daytime office occupancy. Meanwhile, the industrial sector faces an excess of supply and a decline in demand. In the multifamily market, Spokane sees strong development activity, though investor interest has waned. Changing demographics are leading to a more balanced investor market, with both local and out-of-market investors participating. Despite challenges, the overall market outlook shows signs of potential improvement, albeit with caution due to federal trade policies and tariffs. In a significant development for Kansas City's North Loop, Arnold Development Group plans a $76.6 million conversion of vacant DST office buildings into residential apartments. This ambitious project not only aims to revitalize the area by transforming unused office spaces, but also sets the stage for further development phases that could introduce hundreds of new residences and retail spaces. The Centennial Building, located at 210 West 10th Street, is among the prominent sites targeted for this conversion. This initiative is part of a broader trend where developers are looking to breathe new life into underutilized office spaces by converting them into residential units, thereby addressing the demand for housing in urban centers. This development reflects a growing recognition of the potential for office-to-residential conversions, particularly in areas where office vacancies are high and there is a strong demand for housing. The project is expected to contribute to the economic vitality of Kansas City's urban core, offering a new lease on life for the North Loop area. Meanwhile, in Kitchener-Waterloo, Ontario, similar trends are being observed as developers explore converting office spaces into residential units to meet the housing demand. This cross-border relevance highlights a shared challenge in urban centers where office space vacancies can be repurposed to fulfill residential needs. As cities on both sides of the border grapple with similar issues, these projects underscore the innovative approaches being employed to tackle urban housing shortages. By turning vacant office buildings into residential spaces, developers are not only addressing immediate housing needs, but also contributing to the long-term sustainability of urban environments. In a significant move for commercial real estate in Shelby County, a massive retail development has secured $20 million in incentives from the city as part of a 20-year agreement. This development is strategically located along the U.S. 280 corridor, which is known for its commercial potential and accessibility. The incentives are expected to catalyze the project's completion and ensure its long-term viability, contributing to the economic growth of the area. This project is part of a broader strategy to revitalize the retail landscape in Shelby County, aiming to attract more businesses and consumers to the region. By offering these incentives, the city is demonstrating its commitment to fostering a supportive environment for commercial growth and development. The US 280 corridor has long been a focal point for commercial developers, given its connectivity and proximity to key urban centers. This latest development underscores the ongoing efforts to enhance the corridor's appeal, ensuring it remains a prime destination for retail ventures. Such initiatives are crucial in the current economic climate, where retail developments face challenges from shifting consumer behaviors and increased competition from online platforms. By investing in physical retail spaces, developers are betting on the enduring value of in-person shopping experiences and the community hubs they create. While this development is taking place in the United States, similar trends are observed in Canadian cities like Kitchener-Waterloo, where retail spaces are being revitalized to meet changing consumer demands. This cross-border relevance highlights the shared challenges and opportunities in the retail sector, emphasizing the importance of strategic investments and incentives in driving growth. In Goodyear, Arizona, Lincoln Property Company and Harvard Investments have announced the delivery of Goodyear Air Park Phase 1, a massive 1.6 million square foot industrial project. This development, consisting of 6 Class A buildings, aims to meet Phoenix's growing demand for mid to large-scale industrial space. The project not only enhances the industrial sector, but also integrates a retail component known as Estrella Gateway. This retail portion, spanning 63 acres, will feature up to 15 pads designed to host full-service retail tenants, providing everyday convenience for park employees and the surrounding community. Strategically positioned at the entrance to Estrella Mountain Ranch and accessible via the MC-85 and the future State Route 30, Estrella Gateway will serve the needs of almost 440,000 residents within a 10-mile radius. The development will commence with the construction of a quick-trip travel center on approximately 5 acres, with construction slated to begin in the fourth quarter of 2025. This initiative underscores the strategic planning involved in creating a comprehensive live work-play environment in Goodyear. Goodyear Air Park is located within a 565-acre master plan, ultimately expected to include approximately 7 million square feet across up to 20 buildings. The first phase targets mid- and large-scale users, featuring 6 buildings with sizes ranging from 81,000 to 775,000 square feet. Each offers up to 40 feet of clear height, a total of 327 dock-high and 28 drive-in doors, private truck courts, and ample parking. The development is a significant addition to one of the valley's fastest-growing submarkets, with its divisibility and connectivity supporting various uses such as logistics, advanced manufacturing, and data centers. This positions Goodyear as an attractive location for major employers and industries seeking long-term stability. The project comes with full utilities infrastructure and zoning for both industrial and commercial use, enhancing its appeal as a speed-to-market option. This development reflects broader trends in industrial and retail real estate, where strategic locations and mixed-use elements are increasingly vital. While Goodyear Air Park exemplifies this in Arizona, similar trends can be observed in Kitchener-Waterloo, Ontario, where industrial developments are also incorporating retail and commercial elements to meet evolving market demands. Such cross-border similarities highlight the shared challenges and opportunities in the real estate sector, emphasizing the importance of strategic planning and investment. In a noteworthy update from the Nashville Business Journal, Oracle Corporation is making significant strides in its ambitious East Bank campus development. According to reporter Sophia Young, Oracle has filed a request to rezone a portion of its River North property. This move comes just months after the company invested over $100 million to further its Nashville expansion, signaling a rare sign of progress on its $1.35 billion tech campus. Oracle's East Bank campus is a major project that reflects the company's commitment to expanding its presence in Nashville. This development is part of a broader strategy to establish a significant footprint in the region, which has seen a substantial increase in Oracle's headcount by 25%. The rezoning request is a critical step in advancing the campus, which is expected to play a pivotal role in Nashville's economic landscape. The Nashville East Bank campus project is a prime example of how tech giants are investing in urban centers to create dynamic work environments. Oracle's expansion efforts include acquiring additional sites in the East Bank area, which positions the company to leverage Nashville's growing reputation as a tech hub. Such developments not only enhance Oracle's operational capabilities, but also contribute to the city's economic growth and job creation. While Oracle's project is unfolding in Nashville, similar trends can be observed in Canadian cities such as Kitchener-Waterloo, Ontario. Here, tech companies are also expanding their operations to capitalize on the region's skilled workforce and favorable business environment. These cross-border parallels highlight the shared opportunities and challenges faced by urban centers in attracting and retaining major tech players. As Oracle continues to advance its East Bank campus, the company's strategic investments underscore the importance of thoughtful urban planning and development. By seeking to rezone key properties, Oracle is taking proactive steps to ensure the campus meets its long-term operational and community objectives. This approach aligns with broader industry trends, where companies are increasingly focused on creating sustainable and integrated urban workspaces. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.